All right. Today, we're cracking open the playbook of an absolute legend on Wall Street, Peter Lynch. We're going to distill his timeless wisdom into a guide that honestly any of us can use. But first, let's talk about what made him a legend to begin with.
So, why should you listen to this guy? Well, it all comes down to this one number 29%. For 13 years straight, Peter Lynch averaged a 29% annual return managing the Fidelity Magellan Fund. I mean, a track record like that, it just speaks for itself. It turns all the theory into just undeniable proof.
And this quote right here, this is the absolute foundation of his entire philosophy. Before we get into any of the tactics, you've just got to get your head around this. You are not gambling. You're not just playing with ticker symbols. You're actually investing in the future of a real company, a real business.
So, here's our game plan. We're going to start by hunting for what Lynch famously called 10 baggers. Then, we'll learn how to classify stocks into his 6 categories, figure out how to manage a portfolio without making classic mistakes, understand the edge you have over the pros, and finally, we'll bust some of the most dangerous myths in investing.
Okay, the 10 bagger. This is the holy grail, right? It's what gets every investor's heart racing. But what's so cool about Lynch's approach is that he believed you don't have to find some crazy, complex tech company. A lot of the time, the biggest winners are hiding in plain sight. So, what exactly is a 10 bagger? It's pretty simple. It's a stock that grows to 10 times what you paid for it. Think about a company like Monster Beverage. Their business is incredibly simple. They just make and sell energy drinks. There are no crazy patents or anything, just fantastic execution. And that's exactly the kind of opportunity Lynch absolutely loved. And I love this quote because it really gets to Lynch's obsession with simplicity. He would actively look for businesses that were so easy to understand, so durable that they could survive even if the management wasn't perfect. A simple business you can explain is almost always a better bet than a complex one you can't. And that leads right into this idea of the story. Before Lynch ever bought a single share, he had to be able to give like a 2-minute speech explaining why he was buying it, what had to go right for it to succeed, and what the big risks were. The rule is simple. If you can't explain it, you don't understand it well enough to own it. All right, so you've got the story. Now what? The next step is to figure out what kind of story it is. Lynch said it's crucial to know what kind of stock you own because each type behaves differently and has different expectations. He broke them all down into 6 main personalities. First, you've got your slow growers. Think big, old, stable companies. Then you have the stalwarts, like a Coca-Cola, reliable growers that do well in a recession. Third, the fast growers. Now, this is where Lynch looked for those 10 baggers. Next up are the cyclicals, like airlines or car companies that go up and down with the economy. Fifth, asset plays. These are companies sitting on some valuable stuff the market hasn't noticed yet. And finally, the turnarounds. These are the beaten-down stocks that could give you huge returns if they can pull themselves back from the brink. And this table just lays it all out, doesn't it? It shows you the risk and reward for every category. See the fast growers and turnarounds? Highest potential gain, but also the highest risk. Asset plays can be amazing, high gain and low risk, but only if you've really done your homework. Getting this is so key to building a balanced portfolio. So, you've found your companies, you've categorized them. Now what? Well, the next part is managing them correctly. And according to Lynch, this is where most people completely mess up. This is probably one of Lynch's most powerful analogies. He watched countless investors sell their best stocks, their flowers, just to lock in a small profit. Meanwhile, they'd hold on to their losers, the weeds, praying they'd come back. It's the exact opposite of what you should be doing. Okay, look at the 2 sides here. On the left, that's the common mistake. It's emotional, it's all about reacting to the price. But the Lynch way, on the right, that's about reacting to the story. If a stock's price drops, but the company's story is still great, hey, that's a buying opportunity. If the price goes up and the story is getting even better, you let your winners run. The price by itself doesn't tell you anything. Now, you might be thinking, there's no way I can compete with these huge Wall Street funds. But here's the thing, Lynch's message is so empowering. He argued that as a regular investor, you actually have some pretty serious advantages over the professionals. First off, flexibility. A fund with billions of dollars can't really invest in a small, exciting company. It's just too tiny to move their needle. But you can. You also have freedom. You're not tied down by a bunch of rules and red tape. And most important of all, you have patience. A fund manager has clients breathing down their neck, panicking and pulling money out at the worst possible times. You
You only answer to yourself. Okay, for our final section, we're going to do a little rapid-fire myth-busting. Lynch identified all these silly but really dangerous things people tell themselves about stocks. These are the mental traps that lead to terrible decisions.
Oh man, this is a classic. You see a stock that's already dropped 50%, and you think, wow, what a bargain. It's so much cheaper now. But that's a trap, and it's based on nothing but hope. And here's the cold, hard truth. A stock that has fallen 90% can still fall another 90% from there. The floor is zero, people. The past price means nothing. Only the future of the business matters. Everyone wants to be that hero, right? The one who buys at the absolute perfect bottom. It feels so good to think about, but it's a really dangerous game to play. Lynch's analogy for this is perfect. It's like trying to catch a falling knife. A much, much smarter strategy is to wait for the knife to hit the floor, stop bouncing around, and then you can safely pick it up. In other words, just wait for the business to show some real signs of improvement. This one feels so logical, doesn't it? A stock that costs $3 feels way less risky than one that costs 50. It's just a trick your brain plays on you.
But the math doesn't lie. Whether a stock goes from $50 to zero or from $3 to zero, you've still lost 100% of your money. It's the percentage loss that counts, not the price tag on the share. And the list just goes on and on. This idea that broken companies always come back, or setting some random price target, like, I'll sell when it hits $10, or thinking that just because a stock went up, you made a brilliant decision. These are all just ways we let our emotions take over instead of using our brains. So after going through all of Lynch's core ideas, it all really comes down to this one last question for you. You've got the framework, you know the pitfalls to avoid. The only thing left to do is to actually apply it. So can you give that 2-minute monologue for every single stock you own right now?